Index funds versus hedge funds. Why the rich keep losing? Hedge funds manage more than $4 trillion. They hire the smartest people from Harvard, Stanford, and Wall Street. They use secret algorithms, private research, insider connections, and billion-dollar strategies. And yet, over the last 15 years, the majority of hedge funds failed to beat a simple index fund. Anyone can buy it on their phone in 30 seconds. No private meetings. No expensive advisors. No million-dollar minimum. Just a boring index fund. So why do rich people still pour billions into hedge funds, even when they lose? Because hedge funds were never just about making money. They were about status. And once you understand that, you'll never look at investing the same way again. Let's break this down simply. A hedge fund is basically a private investment club for wealthy people. You give them your money. They promise to beat the market. Sounds fair, right? Here's the catch. Most hedge funds charge something called 2 and 20. That means they take 2% of your money every year, no matter what happens. Then they take 20% of any profits they make. So imagine you invest $1 million, even if the fund does absolutely nothing. They still collect $20,000 from you every single year. Now imagine they make 10%. You'd think you made $100,000. Nope. First, they take their 2% fee. Then they take 20% of the profits. Suddenly your return drops massively. But here's the crazy part. If they lose money, you absorb the losses, not them. You lose 15%. They still get paid. Imagine hiring a chef who charges you full price even if the food tastes terrible. That's basically the hedge fund business model, and the numbers prove it. Most investors aren't paying for performance, they're paying for the idea of sophistication. In 2008, during the financial crisis, Warren Buffett made one of the most famous bets in investing history. He challenged the hedge fund industry publicly. His bet was simple. Over 10 years, a low-cost S&P 500 index fund would outperform. It would outperform a group of elite hedge funds, not random hedge funds. Handpicked professional funds chosen by experts. The stakes? $1 million. At the time, many people laughed at Buffett because hedge funds were supposed to be smarter. They had analysts, research teams, trading systems, complex strategies. Meanwhile, the index fund did absolutely nothing. It just tracked the market. No predictions, no timing, no genius. And after 10 years, Buffett destroyed them. The S&P 500 index fund returned around 125%. The hedge funds? Only about 36% combined. That's not a close loss, that's domination. And Buffett's point was simple. Costs matter. Most active managers don't fail because they're stupid. They fail because fees slowly destroy returns. Imagine two people investing for 30 years. One pays almost no fees. The other loses 2 to 3% every year to managers. That tiny difference compounds into hundreds of thousands, sometimes millions, of dollars. The rich weren't getting richer, the fee collectors were. So why do index funds keep beating hedge funds? There are 3 major reasons. 1. Fees destroy performance. This is the biggest reason. An index fund might charge 0.03% annually. That's basically nothing. A hedge fund charges 2% management fees, plus 20% of profits. Over decades, those fees become devastating because investing is all about compounding. If your money grows at 10% yearly, it doubles roughly every 7 years. But if fees drag your returns down to 7%, your wealth grows dramatically slower. Wall Street loves complicated investments because complicated investments justify high fees. But simplicity often wins. 2. Diversification beats concentration. An S&P 500 index fund owns shares in 500 major companies. Apple, Microsoft, Amazon, Google, hundreds more. If one company struggles, the others keep growing. But many hedge funds make concentrated bets. Maybe 20 or 30 positions. That means one terrible trade can destroy an entire year of returns, and markets are unpredictable. Even smart people are wrong constantly. Index funds accept uncertainty. Hedge funds try to outsmart uncertainty. Historically, that hasn't worked consistently. 3. Index funds remove emotion. Most investors lose money because of emotions. Fear, greed, panic, excitement. Hedge fund. Managers constantly react to the market. They buy, sell, predict, trade. Index funds do none of that. They simply own the market. And historically, the market trends upward over time. Not every year. Not every month. But over long periods, yes. The stock market has survived recessions, wars, crashes, pandemics, inflation, political chaos, and still continued growing. Index investing works because it removes the need to be smarter than everyone else. You just need patience. Now here's the part nobody talks about. If hedge funds underperform so often, why do rich people still invest in them? Because hedge funds sell something more powerful than returns. They sell exclusivity, status, access. Think about it. Most hedge funds require $1 million minimum, private invitations, elite networking, special memberships. That exclusivity creates a psychological effect. People assume, if it's expensive and hard to access, it must be better. But investing doesn't work like luxury fashion. A $5,000 watch may signal status. A hedge fund may signal status too. But neither guarantees performance. In fact, many wealthy investors secretly underperform because they overcomplicate investing. Meanwhile, an ordinary person investing $300 or $500 monthly into index funds quietly builds wealth for decades. No headlines, no private meetings, no CNBC interviews. Just consistency. This is why personal finance is often less about intelligence and more about behavior. The average investor doesn't need elite strategies. They need discipline. Because the market rewards patience more than ego. And that's hard for many wealthy people to accept. So what's the practical lesson here? If you're just starting investing, don't overthink it. You do not need complex trading systems, expensive advisors, secret stock tips, crypto hype, day trading courses. Start simple. Many investors begin with broad index funds like VOO, VTI, or total market index funds. These funds instantly give you ownership in hundreds of companies. Then do something incredibly powerful. Automate your investing. Set up automatic monthly contributions. Even $50 a month, $100 a month, $300 a month. Consistency matters more than timing. People waste years waiting for the perfect moment to invest. But historically, time in the market beats timing the market. And here's another important truth. The stock market rewards long-term thinking. The people who usually fail are the ones constantly jumping in and out. They panic during crashes. They chase hype during bubbles. They buy emotionally and sell emotionally. Index investing removes most of those mistakes. It turns investing from gambling into a system, and systems beat emotions. Every time, here's the uncomfortable reality. Most people don't fail because investing is hard. They fail because boring feels wrong. People want excitement. They want the next Tesla. They want overnight success. Wall Street understands this perfectly. That's why financial media constantly pushes breaking news, stock picks, predictions, hot trends. Because excitement keeps people watching. But wealth usually grows quietly, slowly, almost invisibly. The millionaire next door often isn't the flashy trader. It's the boring investor who bought index funds consistently for 25 years. No drama, no genius, just patience. That's what makes this so powerful. Index funds democratized investing. For most of history, ordinary people didn't have access to diversified portfolios. Now anyone with a smartphone can invest like institutions used to, and ironically, the simpler strategy ended up outperforming many professionals. So here's the real lesson. The investing world often confuses complexity with intelligence. But complexity usually benefits the seller more than the buyer. Hedge funds make money whether you win or lose. Index funds quietly let compounding do the work. That's why Warren Buffett said this is one of the best investments most people can make. Not because it's exciting, because it works. So ask yourself, are you investing to look smart? Or investing to build wealth? Because those are not always the same thing. The rich keep paying high fees chasing exclusivity. Meanwhile, patient investors keep quietly winning. Smart investors don't pay more to lose. They pay less and let time work for them. If you enjoyed this video, follow Future Finance Lab for more. One simple investing lesson every single day. And remember, this is not financial advice. Always do your own research.